Today, we are diving deep into a really interesting situation in the stock market. We're looking at a powerhouse of a company, but its stock, well, it's flashing some serious warning signs. The company is the French software giant Dassault Systems. So let's get into it and figure out if this is a hidden gem or maybe a bit of a value trap. Right off the bat, you can see the conflict we're dealing with. On one hand, you've got this fundamentally strong, very profitable company. But on the other hand, the stock itself is screaming, be careful. And that's really the central puzzle we're going to solve today. I mean, how can a really good company be a risky investment at this exact moment? Okay, let's just cut straight to the chase. The final verdict from this deep dive analysis is pretty clear. Wait, but the big question is why? So in this explainer, we're going to unpack all the evidence that leads to this recommendation. We'll look at the risks, sure, but also the underlying strengths, so you really get the full picture. So let's kick things off with the red flags. The report really zeroes in on 3 specific, data-driven reasons why right now is probably not the time to jump in. These are the things that are really waving the caution flag. First up is momentum. And wow, what this slide shows is a really clear and consistent downward trend. It doesn't matter if you're looking at the last month, the last 3 months, or the last 6 months. The stock is heading south. A drop of nearly 24% over 24 weeks, that is a powerful bearish signal. It tells you that right now, sustained selling pressure is the name of the game. Next, the stock fails a pretty important screening test. See, this particular strategy relies on something called the Zacks rank, which is all about earnings estimate revisions. And for this approach to work, you're really looking for a stock that's a strong buy or a buy. Well, Dassault Systems is currently ranked as a hold. Now, a hold isn't a sell, but it does mean it's only expected to perform in line with the market, not beat it. And for finding a real winner, that's kind of a deal breaker. And now for what might be the biggest red flag of all. The insiders are selling. This is such a powerful signal because, these are the people who know the company inside and out. When you see executives and major shareholders selling off shares, it kind of suggests their own conviction in the stock's short-term future might be shaky. And as you can see, we're not talking about tiny moves here. We've got major shareholders, directors, deputy CEOs, all reducing their positions. That one little purchase, it's completely dwarfed by all the selling. So we've seen the red flags, but this is where the story gets really interesting. Because for all those warning signs, the company itself is actually fundamentally strong. Let's flip the coin and look at the other side of the ledger. Let's see why Dassault is a stock to keep on your watch list, even if it's not one to buy today. Despite all that negative momentum in the stock price, the business itself is making money. It's got a stable trailing earnings per share of about 86 euro cents. This tells us the company's fundamentals are solid. It's profitable. It's generating consistent earnings, and that's exactly what you want to see in a healthy business. The stock also passes a key practical test, liquidity. With an average of 1.4 million shares changing hands every single day, it means you can easily buy or sell your position without pushing the price around too much. That's a sign of a really healthy, mature market for the stock. Okay, let's talk valuation. And this is where things get a little nuanced. If you look at this chart, you can see Dassault's price-to-earnings ratio, that's the first bar here, is sitting around 31. So yeah, that makes it a little more expensive than the average S&P 500 company in the middle. But, and this is a big but, when you compare it to its peers in the tech sector, that bar on the far right, it's actually trading at a pretty significant 24% discount. So this suggests there could be some relative value here, but that discount might also just be reflecting the market's current worries. So what do we do with all this? We've got a stock with terrible momentum and some concerning insider selling, but it's tied to a profitable company with what seems to be a reasonable valuation for its sector. How do we weigh these conflicting signals? Well, this is where the report brings it all together for us. I think this quote from the source material just sums it up perfectly. When you put together the neutral Zacks rank, the insider selling, and that relentless downward momentum, the conclusion is pretty clear. For an investor who's looking to make a profit, the short-term risks just seem to outweigh the long-term strengths, at least for now. But here's the key. Wait doesn't mean walk away forever. A disciplined approach needs a plan. So this analysis actually lays out a strategic waiting game. It gives us a very clear set of signals to watch for that could flip this stock from a wait into a buy. So we're not just waiting around, we are actively monitoring. And here is your checklist. First, you want to see that Zacks rank get better, improve to a buy. Second, that whole momentum cascade needs to do a U-turn and go from red to green. Third, you want to see the insider story completely reversed. You want executives to actually start buying shares. And finally, on the technical side, you want to see the stock price stop falling and start building a nice, stable base. And only if those triggers get hit, the report provides a potential playbook. It suggests the purchase price somewhere in the zone of 26 to 27 euros, a very clear stop loss to manage your risk, and even gives you initial and secondary targets for taking profits. Now, this isn't a recommendation for today. Think of it as a conditional plan, ready to go if and when the facts on the ground change for the better. And that really leaves us with the big question, doesn't it? Is the market's current pessimism about Dassault Systems just reflecting some temporary problems that'll eventually pass? Or is it seeing a more permanent, long-term decline? The framework we've just walked through gives you the exact tools you need to watch the data and ultimately decide for yourself.